morning, everyone. This is Barry Knapp from Ironsides Macroeconomics. It's Tuesday morning, February 8th. I'll begin with an apology for not getting this audio and video out yesterday, Monday the 7th. I was at a location in southern Florida with very sketchy Wi-Fi and internet connection and was unable to do it. So again, my apologies. The note this week, released on the 5th, was titled "The Battle Over the Balance Sheet." This is my ongoing saga about how I think the Fed really should be approaching the normalization process versus the trajectory that they're on thus far. So there were 4 sections to the note. The first section was a market summary where I walked through the stage of the business cycle that we're at, some of the comings and goings of the market. That section was titled "In Your Facebook." I then wrote "The Battle Over the Balance Sheet." That's the second section of the note. The third section of the note was titled "Slacker Joe." It was about the diminished labor market slack and a summary of the payroll report and the issues related to that. And then finally, "Slow or Not Slow," which is the growth outlook. Some of the incoming macro data to me was very encouraging last week. So let's begin with the markets. For us, the really big, compelling story around the markets is what stage of the business cycle are we at? There's been strategists out there that argue we're already into mid-cycle, that we're going to have a very short boom-bust cycle this go around. The back end of the Treasury market could support that view. The 5s, 30s curve, even 2s, 10s have been flattening. 2s, 10s, 2-year forward has flattened a lot. That would argue that we're late in the business cycle. I think that's a flawed argument because of the Fed's role in suppressing term premiums, and I'll come back to that in the discussion on the balance sheet. Nonetheless, that's a major consideration. This cycle was not different this time. During the first year, the sectors that were supposed to outperform, small caps, materials, consumer discretionary, financials, and tech generally, all performed exactly as you'd expect. So this had classic business cycle type activity. The Fed should have been normalizing policy probably a year before they did, but that notwithstanding, we did follow typical business cycle patterns. For us, though, the real important issue as an investor is, when do we really transition from that early stage, early cycle activity to mid-cycle? And for us, it is the first Fed policy normalization related correction that marks that transition to mid-cycle. And we thought that was really on offer last week, in particular and so far this year, with technology's continued underperformance and this idea, this thesis that we first latched onto back in August of 2020, that this cycle was going to be a mini version of the 90s and 2000s, where in the 90s, the tech sector built out a ton of capacity. The poster child for that would be fiber optics capacity. And then in the 2000s, the benefits of that accrued to the media sector and the birth of streaming, for example. And so this last cycle, when tech had that massive outperformance through the 2010s, as the cloud was built out, the whole digitization era, we really think those benefits are going to accrue to the consumers of that technology or users of that technology in the 2020s. We also think these big platforms that supposedly have monopolies that need to be broken up by Lena Khan and the FTC and the just DOJ and his enforcement division. This just got us thinking about Milton Friedman and how Friedman argued that the only monopolies that can be maintained are the ones that the government supports. And so, Facebook struggles, which were on offer with the stock dropping 25% on Thursday, and then Knapp reporting on Thursday night, and that stock soaring. To us, it's pretty evident that these are not sustainable monopolies, that by the time the government gets around to antitrust, they're already getting their monopolies cut into. We cited Amazon struggles and at least stock price struggles in 2021 as a consequence of that. Of course, Amazon had quite a day on Friday, which brings us to the final point I'd like to make with respect to the markets right now. Last year, 2021, we had low realized market volatility And implied volatility traded at a big premium to that, in part because implied volatility was yet another asset that could be financed with negative real interest rates when 10-year real yields were less than negative or 1%, negative 1%. All assets look cheap. Now that is changing, it's harder to carry that implied volatility, but realized is going up because the liquidity environment has changed so much. Again, that's one of our themes for the year. And you saw that with Meta's, market cap falling 25%, and then Amazon's going up 15% or whatever it was on Friday. This tremendous market volatility, realized volatility, and we think that actually paying that premium for options is going to make more sense this year, although it's going to be harder to carry. But that's the environment that we're in. We think it'll persist through the first half of the year. How that unfolds and how violent those drawdowns are, and the length of the business cycle has a lot to do with how the Fed handles the normalization process. So we saw a very credible argument last week that were the Fed to just end reinvestment cold turkey, they would only get the balance sheet down to 25% of GDP based on some reasonable forecasts for nominal GDP and for mortgage prepayments, so on and so forth. They'd only get it from 37% of GDP to 25% of GDP by the end of 2023. Pre-pandemic, it was 19% of GDP, so that impulse will still be out there. They really need to be much more active around balance sheet contraction. And the first round of speeches post the FOMC meeting were wholly unsatisfactory to us, other than Esther George, the president of the Kansas City Fed speech. That's worth reading, particularly the section where she talks about monetary policy and how she thinks that the long end rates are suppressed by 150 basis points by Fed purchases. We published a chart of the 2s, 10s term premium curve. Bill Dudley's talked a lot about term premiums being suppressed by Fed purchases. When you hear Fed officials say, well, long-term expectations look contained, that's because of the suppression of long-term rates. We already had this incredibly large divergence between 5-year real rates and 5-year inflation break-evens. That's starting to ease somewhat, but it's a really circular argument because the Fed is holding down those rates and then getting some comfort from the fact that long-term market implied inflation expectations aren't that high. It's a really goofy argument. They would be much more effective in normalizing policy, cooling off housing inflation were they to actively manage the balance sheet. But the doves want to raise rates to at least 1% and then run the balance sheet contraction in the background. That is insanity. And that's not how it should be conducted. We'll see. We'll likely get the Humphrey Hawkins testimony from Chair Powell in the next couple of weeks. And we hopefully will hear more, and hopefully we'll get some serious Fed speeches about this, and they'll really start to take this issue seriously, because it'll have a lot to do with how the markets unfold over the next few months as to how they handle this. If they simply use their blunt instrument and raise rates 7 times this year, as Bank of America is calling for, they run the risk of a real policy mistake. I don't believe the private sector is particularly vulnerable to higher rates. It's just a bad way to try and drain liquidity out of the system. Okay, that's it on that. On to the labor market. The picture that emerged after the JOLTS report was released a week ago today was a labor market that has become less dynamic, perhaps because of the Omicron variant, and gotten even tighter. And so that wage pressure is surging. The employment cost index showed service sector wages rising at a 5.25% annualized rate, just as service sector demand's about to pick back up. That's bad news for the Fed. The non-supervisory average hourly earnings series is running at a 6.9% annualized rate right now. The most fascinating, subtle point from the employment report released last Friday, yes, there was a big upward revision to the last couple of months. Okay, that changed the picture. But really more interesting was the revisions through the course of the year. Didn't change the overall growth of jobs. The growth of jobs the monthly average went from 537,000 jobs per month in 2021 to 555. So a trivial change. That standard deviation went from 295 pre-revisions to 137. So now when you look through that, and again, it's a chart that was in our weekly, what you see is there was the slowdown in hiring in April and May, right after the American Rescue Plan was passed, because everyone was able to stay home and collect checks. It then started to recover. There was no deceleration for Delta. There was no deceleration for Omicron. In retrospect, and of course, the Fed didn't know this at the time, and the fiscal officials didn't know it, but it makes the policy stimulus look so misguided. And it makes it look like the Fed and fiscal officials are so much farther behind the curve. Looks like American Rescue Plan should have never happened. It looked like they should have started tightening policy mid-year last year at the latest. And because we basically just created 550,000 jobs per month through the course of the year with no real slowdowns. So the economy really didn't need that level of stimulus. It was coming back on its own. So that's it on that. The Fed has got a big issue here with the labor market and wage growth, and they're going to have to get out in front of it. And again, the right way to do it is with the balance sheet, because that was the bulk of the stimulus last cycle, not rate cuts. So just jacking rates up is crazy time. So on the growth outlook, we have found some very encouraging stuff last week. First of all, the productivity numbers are very strong. And here's the productivity picture as you see it over the last decade. From 2011 to 2017, productivity growth averaged 0.7%. That's against a greater than 2% post-World War II average trend. Though from 2018 through 2021, it's now averaged 2%. This, we think, is attributable to increased labor dynamism. This is attributable to technology innovation adoption, substituting capital for labor in the services sector in particular. And we think we'll have all three inputs to productivity firing in 2022: capital deepening, labor productivity, and technology innovation adoption. Again, very good news. And you could see this in corporate profit margins, which are increasing, have increased this quarter in every sector except staples, which is the one that you'd expect to struggle the most with the inflation surge. So again, very good news. The other interesting number last week was auto sales, right? So we have this narrative that we're going to move from goods consumption to services consumption, except that auto sales have been running at 12.5 or 13 million as an annualized selling rate against underlying demand, which is probably 17.5 or 18. In January, we did better than 15. Big surprise to the market. That muddies that picture. Our view is that the mix of consumption is less important than the mix of investment versus consumption. And we think 2022 is a big investment year, and that'll be good news for equities. So overall, we see strong CapEx, bottoms up CapEx, R&D spending. We see productivity getting better. We see margins getting better, auto sales, all this stuff. Yeah, ISM manufacturing is going to start to fall, and global PMIs are going to come down. But if you listen to the naysayers on this, we would have already fallen from 60 down to 50, and we're still at upper 50s in the US. So we're not so worried about that from a US perspective. Remember, we run big current account deficits and trade deficits. So this is not going to be a big issue for us. The bigger issue is, do we get the investment surge we expect? Do margins hold up? Do we get a productivity dividend? Was the pandemic a positive productivity shock? We think the answers are yes. The underlying growth outlook is fine. We've got this liquidity dynamic and a Fed that is struggling to figure out how to unwind policy. So still a difficult environment for the next few months, but with a good underlying fundamental story. So that's it for me this week. I'll try to get it out on Monday next week. Have a good week, everyone. I'm around if there's any questions. Barry Knapp, Byron Sides Macro. Thanks.